Investors' search for diversification and a focus on elevated inflation have put a spotlight on infrastructure, made brighter by massive public investment programs, accelerating power demand, and an increasingly digitized global economy. Against that backdrop, let's focus on four key topics on investors' minds when it comes to global listed infrastructure: tariffs, diversification of the asset class, interest rates and the macroeconomic backdrop, and our overall outlook. Regarding tariffs, we believe infrastructure companies tend to be less exposed to the negative effects of tariffs. Infrastructure assets typically have strong pricing power, which means these businesses are often able to pass higher costs on to their underlying customers. While some sectors within infrastructure are sensitive to trade and global demand, predictable revenue streams driven by long-term contracts tend to make this asset class a bit more defensive than broad equities. This has resulted in infrastructure investments tending to have lower volatility than broader equities. Further, infrastructure is benefiting from strong secular themes that we believe will keep their momentum almost regardless of tariff pressures. I'll touch on this a bit more later. Now, what about diversification? According to Preqin, portfolio diversification is the top reason institutional investors allocate to infrastructure. And we believe listed infrastructure is a strong portfolio diversifier, offering favorable downside protection while maintaining equity-like returns. All told, listed infrastructure includes about 250 investable companies globally with a nearly $7 trillion market cap. With 60% of the universe in the US, we see opportunity, not concentration risk. There are ample opportunities in Europe, Asia Pacific, and emerging markets broadly. By sector, listed infrastructure offers allocations to a diversified basket of companies, providing differentiated portfolio construction across what we have coined the CUTE subsectors. These are communications, utilities, transportation, and both traditional and alternative energy. Turning to the macroeconomic backdrop, we believe current market dynamics can provide tailwinds for infrastructure for a few reasons. One, the uncertainty premium being priced into the market is beneficial for infrastructure as an asset class, which provides more predictability in an environment of weaker economic growth and sticky inflation. Two, our macro view is that we do expect short-term yields to decline in the near term as the Federal Reserve lowers rates, reflecting expectations for looser policy ahead. But at the same time, we expect inflation break-evens to rise due to this policy easing and supply pressures. In fact, inflation continues to creep further away from the Fed's 2% target. A market in which real yields fall and inflation break-evens climb is a favorable outlook for infrastructure, and historically, infrastructure has significantly outperformed when this was the case. Finally, infrastructure assets can benefit in a lower interest rate environment due to their capital-intensive nature. Lower rates reduce capital costs, with cell towers and utilities most sensitive given their higher leverage. Regarding our outlook, we seek to maintain a generally balanced portfolio given the current turbulent market environment and the elevated level of geopolitical tension. With all the good stuff listed infrastructure has to offer, it may surprise investors to learn that the asset class is trading at a significant discount to global equities and its historical valuations. We also see three megatrends converging to unlock compelling investment opportunities: surging power demand, digital transformation, and the supply chain reinvention. So let's start with power demand and decarbonization. U.S. electricity demand is rising fast, over 3% annually through 2030, driven by AI, data centers, electric vehicles, and advanced manufacturing. Data centers alone could consume nearly 12% of total power demand by decade's end. Meanwhile, renewables are accelerating and projected to grow from 10% to as much as 50% of global generation by 2040. Second, digital transformation. The digital economy is exploding, with mobile data traffic tripling and 5G expected to carry 80% of global traffic by 2030. AI is amplifying demand across industries, prompting major infrastructure investment. And third, deglobalization and supply chains. Global supply chains are being restructured as companies nearshore production in response to these geopolitical tensions and pandemic disruptions. U.S. manufacturing construction has tripled in 3 years, boosting demand for infrastructure that moves goods, railways, ports, airports, and toll roads. These secular trends, when combined with the long-term diversification, growth potential, and return consistency provided by global infrastructure, make a compelling case for the asset class. Thank you for listening.